everybody. This is George, and well, welcome back. Well, I guess I'm welcome back since I was gone again. Had a absolutely amazing time. A friend of mine, Scott Flake, that I've known since he was in 6th grade. Well, we were both pretty young at the time. Anyway, so he actually retired out of the Air Force after 34 years. And what an amazing career that man has had. Holy smokes. Anyway, I thought I did some pretty amazing things in the fire service. Absolutely, he ran circles around me. Now, that's just absolutely amazing. I'll share some of that later. But here's the thing, right? Let's talk a little bit about the fact that, well, interest rates came down, but wait a second. The Feds raised rates. I thought that the Feds controlled mortgage rates. Well, we're going to get into that. We're going to talk a little bit about no, that's not true. And we're going to go through what's going on, what to expect, and how best to navigate this market. However, here's the thing. Let's remember to subscribe, share, and like our channel. Listen, every time you guys subscribe or you share, it allows others to see this information. And because there's no selling, because it's just really good, solid, real-time, right now information, hey, share it. Share it with people that you like. And, subscribe. You get alerted when these come out. Besides, I'm a lot of fun to watch and listen to sometimes. Anyway, all right. Hey, so let's get the show on the road. I think I already said that. Key thing to understand when we take a look at inventory is the fact that even though we're at 973 homes, basically we have 1,477 that went pending. So very, very consistent since the middle of October. For every home that comes on the market, 2 have been going off market or very close to it. So we have been drawing down this inventory. So like right now we should have 18 to 22,000 homes on the market. However, we don't. We have like 7,000 homes available on the market today. And as you can see, the solds are still progressing. They're still happening. Sure. As you can see, we've highlighted there, we've got some price reductions, absolutely perfectly normal, little bit higher than I would expect at this point in the marketing. That just means sellers are being a little too aggressive. Okay, now listen, sellers, pay attention here. It's not like if you have sold a home, and bought a home years ago, and you're like, if you put the home on the market, 15, 20 years ago, well, probably about 15 years ago, even 10 years ago, a buyer would come in and make a lower offer if they didn't like your list price. They're not doing that. They haven't been doing that since about 2019. Why? Because they're just going to wait you out. And they're like, somebody else will make an offer. I don't want to make a low offer. I'm going to wait. So you understand there's a lot of metrics that are available to buyers and like yourself out in the market. And you have that knowledge and they know what is a good value and what is not a good value. And when you look at homes that either expired or canceled, or in this circumstance, a price reduction, you were overpriced. Now, whether that came from bad information or misinformation from your agent, or you just have that, I'm sorry to say this, sentimental equity where you think you just know your home is worth more. You just know it. You feel it in your bones. Well, sentimental equity has a 0 value. And as you can see, many people are experiencing that. If you are guessing at what your value is, or maybe you think because, the neighbor next door sold theirs for this, and by golly, I have better flooring. Doesn't matter, okay? The picture is price is the first impression that a buyer has of your home. So make sure that when you are giving your best foot forward, that you're also being realistic on price. Because here's the thing. If you overprice your home, okay, let's go through the metrics. And I have proven this time and time again, but let's go through the metrics. If your home sells between the first 7 and 10 days, technically 7 days, you'll get between 100 and 107% of list price. Maximum dollar, you get more competitive offers, possibly multiple offers, and you have less contingencies that a buyer puts forward. However, if you miss that mark, You watch 20 days. Well, you're only going to look at 98, maybe 96% of list price. Okay, so you're already taking dollars out of your pocket from overpricing. Plus, buyers are going to ask for more contingencies, maybe even closing cost cover, things that now start chipping away at what should have been in your pocket. If you miss that mark, you go out to 40 days. You're only looking at 92, maybe 93% of list price. Again, time on market is directly proportional to what you have in your back pocket. Look, if your intent is to get your home sold, look, you need to look at the 7 to 10 day market window. That is where, statistically speaking, you're going to get the highest dollar. Keep that in mind as you're considering price, because in a low inventory market, now we already said you should be between 18 and 22,000 homes in our market inventory right now. We don't have that at all. 7,000. And that's only because it's a Friday and we saw a bunch of homes come on market. It's been around 6,800. That's 1.4 months of inventory versus 4 to 6 months of inventory. Keep that in mind. All right, moving on. Getting off the soapbox. All right, because the goal is to help you. All right, let's move on. All right, when we take a look at our chart here, this is kind of an important one. As you take a look at the far right-hand side, and then you take a look at where the blue peaked mark is on the left-hand side, you can see that those are inconsistent, right? Meaning that you can see that last year we had a big influx. Why? Well, because mortgage rates had started to peak at that point. They were in the well into the sixes, and buyers started pulling back, and sellers started pulling back. And so the problem is that was a slowing progress, and there were a lot of sellers that were trying to capitalize on that market opportunity. And the problem is that some of them didn't sell because they missed that message. All right, so we were talking about inventory. Look at this. So we're basically 11% less inventory year over year. So remember, if you go back and look at my channel, we've been doing this since 2007. All right, go back to January, and you'll see that we were at like 228% more inventory than what was on the year before. Now, part of that is because, we'd had a super dry inventory. But now we actually have less than we had last year. Well, wait a second. What? Yes, we have less inventory than we did at this time last year. Rates are a little bit better. Rates actually came down. That's why you're seeing applications, mortgage applications, and multiple offers on well-priced homes, which you're going to see a little bit later by the big R, where those homes, well-priced, are going off market quickly. People overpriced, they're staying on market. Go figure. All right. Remember, sentimental equity has a zero value. And when we start to run into that, it's super hard to overcome, but you need to open your mind up. It doesn't matter what you think. It only matters what the buyer thinks. Because unless you want to keep the home, you want to know what the buyer thinks. All right, moving on. All right. Okay, so when we come back here and we take a look at this chart, so you can see that our solds are basically 30% less than what they were year over year, year to date. And that's a big number. And the big reason that we're seeing this is because we just don't have enough homes coming on market. Okay, that's a given. Why? People just don't want to give up their 3.5% mortgage until rates start to come down, which makes it a little bit more, let's call it reasonable, right? All right. So the however is a lot of people are starting to adjust. They're tactically approaching this, knowing that more than likely Q4, fourth quarter of this year, and 2024, as we are looking at some of the metrics and forecasting, that we're going to see interest rates pop down into the fives, which means that, we'll see a bunch of refis. Yeah, we'll see. Who knows, right? All right. We move on to the next one, new construction. Remember, what's super important about new construction, it used to make up only 10% of our market. And now it's making up at about 31% of the market. And as you can see in the middle column there, we're at 109% more sales pended than we were this time last year for the same month. And you might be saying, what? How is that possible? It's super simple. Builders aren't stupid. See, they have in 2022, they started scaling back, started slowing everything down and doing fewer releases to maintain plat integrity, offering a lot of incentives. In fact, 62% of homes that were out there had some form of an incentive, and that has been pulling back to about 48% because with the limited inventory, the limited few number of homes out on the market, builders are saying, hey, we can release some more because there's not enough existing homes, and people are more inclined to buy new construction, but we'll offer varying credits and whatnot, maybe a move-in special, maybe not. And they are getting multiple offers in some of the nicer areas. So keep that in mind. If you're looking for new construction, it's still a great opportunity because we are seeing more of the inventory from builders coming on because there's not as many other homes, which is brilliant. Go figure. All right. So when we take a look at the next slide, which is our foreclosures, this is super interesting. Now, some people are saying, oh, George, there's this shadow inventory that's coming in. It's going to be crazy. I laugh. Come on. I don't know. Okay. So yes, there's the doom and gloomers. There's these people that talk about, crazy things happening. Let me tell you the real scoop here. And you can see it by, these are real metrics. These are real time. And we're going to pull in some metrics, from some recent reporting from the Mortgage Brokers Association, which supports, again, what we've been saying. First is our inventory, our REO inventory is like super low. In a small number, you might say, well, George, look at the percentage of homes over last year, this year, they're a lot higher. Yeah, they're like 20 homes throughout half of Washington state. That's nothing. That's peanuts. And in fact, if you look at a chart of where they are, they're one-offs. There's one over in Lacey. There's one down in Pacific. There's one in Eastern Washington kind of thing. They're all over the place. All right. Now, are we seeing, sorry, I've got this hair there. Are we seeing more and more activity as far as investors wanting to come in? Sure. Are they finding great value here? No. Why? Because banks are super smart also. They do paint, carpet, and vinyl, and they get the home on the market at market value, and they're selling. There you go. Are they overpricing them a little bit? No, in some areas, they are. Absolutely. So let's take a look at this. Mortgage delinquency rates are at historic lows. Really? Gosh, that's amazing. If we blow this up, here's the message at the end of the day here. All right. So you've got first quarter rose a little bit, 0.16. Okay. That's pretty small, right? As far as delinquency rates, okay, have actually decreased by 34 basis points. FHA and VA, they're the biggest winners here because we're seeing less and less default. Really, at the end of the day, a lot of the folks that were forecasting and expecting, this big shadow inventory to come on, they're saying, hey, you know what? All things considered, mortgages are doing a heck of a lot better than what we projected. And, default rates are really down and is awesome. There's a lot of workout programs to keep people in their homes and whatnot, including 40-year mortgages. So there's tons and tons of benefits out there. The credit unions that we work with and whatnot that work with their members. Listen, I'll tell you, if you've got a mortgage with a credit union, you guys have people actually who've got your back. They absolutely care. They will do what they can within reason. They will do what they can to make sure you can keep in the home and to follow the guidelines and to, make you successful. The big box banks, they don't do that. They can't do that. For credit unions, they're awesome sauce. And in fact, they have a big conference coming up. And so we'll get some really great metrics out to them for that. In the meantime, hey, let's take a look at the next slide here. All right. Mortgage rates. Mortgage rates actually came down. Now, that's super interesting because a lot of you have looked at it and said, wait a second, George. Well, the Feds, they raised rates 1/4 point, 25 basis points. Yes, but understand, be very clear. The Feds control your home equity line of credit, or what's called a HELOC, your credit card. So if you have credit cards, they just raise your rate again, okay? If you have a car loan that you're trying to get, your rate just went up, okay? That's what they control, short-term rates. What rates they lend between banks, that is what the Feds control. mortgage-backed securities, 10-year treasuries. That's what you need to be watching. Watch your bonds. That, like this slide shows here, is what it looks like, because believe it or not, and most people are like, oh my gosh, you're right. It's a publicly traded stock, and that is what controls what rates do. And that is super important, because even though the feds don't control long-term mortgage rates, they do have an effect. And funny enough, just like this, like we've said in the past, many times when the Fed raise rates, mortgage rates go down, and for a variety of different reasons, right? When we take a look at this slide, which I thought was super important by the big R, fewer homes are selling than usual, but the ones that are going fast, right? And so when they take a look at this and they say, you know, this week's inflation report shows a slight slowdown in price gains, confirming that the mortgage rates are likely to stay about where they are for the next few months. I totally agree with that. And I think that we are going to see, even though, you know, mortgage rates bobble up and down. Here's something that's super important. I was just meeting with some really great new clients on Wednesday. And here's the thing. They're talking about, you know, the rates that they're getting quoted and everything else. And I'm like, hey, that's fine. But please understand, the rate that you're quoted, because they were quoted in the morning, may not be the rate in the afternoon, may not be the rate at the close of business. In fact, tomorrow could be completely different. What you're looking at is a snapshot. When you get a pre-approval, okay, remember, that's a snapshot at that point. You have to have a signed purchase and sale agreement in order to be able to lock your loan. There were some programs out there that allowed you to, you had to lock within 60 days, or you had to have a purchase and sale agreement within 60 days so that, you know, you could lock at that point and lock in at a better rate. Those, I think, have pretty much gone by the wayside. There's a lot of different programs that are out there, but understand, until you have a signed purchase and sale agreement between a buyer and a seller, you can't lock your rate. So it doesn't matter what you look at today. You say, ooh, I'm going to go with this lender today because they gave me my best price. Hey, if you're not under contract, it doesn't matter. You may be under contract 2 weeks later, 6 months later. Okay, well, you need to evaluate what the rates are at that point in time. That's the only thing that matters. And loan programs and lenders, they change all the time as far as rates. If they want to slow down their mortgage process, as far as applications, they raise rate, it slows it down. They lower the rate, more applications come in, and they can ebb and flow depending on how their production is going based on that and terms and everything else. You need to watch the video. 5 questions to ask when getting quoted rate. Super important. Go back, watch the channel. I think we can post that too. All right, moving on. This is kind of important. This kind of supports what we were talking about, that even though despite there's a inventory crunch, pending sales have increased over the last week. Mortgage purchase applications are up 5%. Rates go down, applications go up. Funny how that works. This spring's housing market is hot but cold, with scant listings making it less active than usual, but fast and competitive at the same time. Okay. A lot of potential home sales are locked up until mortgage rates come down to a level in which current owners, these are sellers that are in waiting, would be willing to sacrifice their 3% rate, meaning that they don't want to give up their 3% rate for a 6% rate. They want the lower rates. That will be coming. Probably never back down to the 3s again. Remember, the feds bought that rate down. Excuse me. You'll probably be in the 5s. Okay, well, that's still a little bit more palatable in a lot of different circumstances, depending on what they are doing. Understand that everything that buyers do is based on mortgage rate and perception of value of the home they're looking at buying. All right, when we go off to our next slide here, rents. Rents, super important message here. So rents have started to stabilize, which is as expected. We predicted that about the end of Q1, rents would continue to be heading in a very slight upward angle, not a steep climb, and which also starts to stabilize a lot of the housing. You can see that even on a national level, as it is on a local level, we're just gradually going up. We're keeping up with basically cost, demand, and everything from the stay at home and everything else. Now that that is completely subsided and we have recovered from that, now you're going to start to see that stabilization, which brings a lot of stability for tenants and for landlords, and then, of course, then for new buyers. Funny enough, 56% of millennials are homeowners, and the others, the other 43% and change that have not bought a home yet, they are either A, looking at getting debt-free, or finding alternatives of ways of becoming a homeowner within the next 2 years. Thought that was a really important stat that came out of the Fannie Mae affordability housing. I thought that was a pretty interesting metric. Here we go. I just loved this one. All right, Mr. Bubble. Mr. Bubble, do we have another housing bubble? Right? It says, if I pop, you're screwed. I thought that was absolutely hilarious. Why? Well, everybody needs a new bubble topic, right? Well, what it is we've got these guys out of, I think it's Indiana. Is it Indiana? I think it's Indiana. Anyway, they're taking a look at what would be the recourse of some of the homes, what we call generational living, where you can have, multiple families in one house. They're saying, oh my gosh, that market is going to shift, and then you're going to find those kinds of homes being left out on the market. My response to that is, hooey. At the right price, everything sells. FYI. Second, there's a lot of folks and a lot of different, because we have very diverse demographic here. Now, understand, I'm not talking about like these guys, or they're talking about nationwide. I'm talking about us here locally. Us locally here, we still have a very, very large population of different cultures where they like families together. So multi-generational living is a big deal and a beneficial deal, right? So keep that in mind as basically as you're looking at that stat, because, well, I don't find it as exciting. Look at this. It didn't take too much to get rid of a really bad idea. So 27 of the states and a lot of people, there was a lot of backlash on, hey, if you have a higher credit score, you're putting more down, or technically it's less than 20% down, we're going to punish you based on rate. That made a huge media poop storm, which cracks me up because, are you ready for this? Since 2008, this has been normal. They offset good borrowers with bad borrowers, meaning that they charge good borrowers a little bit more than bad borrowers as far as fees. Why? Because it offsets them. That's why. They've been doing that for years. That's not new. I'm not sure why this one just really became crazy, other than the logic behind, the metric of who pays more, who pays less. Way confusing. I don't know who designed it, but I'm glad it is gone. But understand, the people that have better credit scores and more down payment, yes, they pay technically a little bit more in rate or fee than the lower ones because they offset it. Remember, this is a risk-based business, and that's how they balance that out. Yes, they get mortgage insurance premiums, plus they offset it with fees. It's not new. It's just this one was a bad idea, and the media got a hold of it and would not let it go. It's like a pit bull on a pork chop. But anyway, I am glad it's gone because it does create a little bit more normalcy. But understand, yes, you're still paying fees, just not like quite what they had. All right. So mortgage applications, they are up 6.3%. No kidding. Rates drop, applications go in, and they improve. The key thing about this one is that as they take a look at different applications, refinances are down super low. No kidding. And buyers are out there and vying very aggressively in getting, as far as through an approval process, a lot further, which is, again, super important. So with that being said, make sure you subscribe, like, share the video, smash that subscribe button. Let's have a little bit of fun with this. Make sure you keep asking questions. We're always here for you. I'll see you guys in the next video. It's going to be an amazing weekend. I'll catch you guys later. Take care.